be 113?
113? But why? Over there it said 100.
Yeah, 113 because of the tax.
Why do I have to pay for your tax? The people already cut tax off of my salary. Then why do I pay an extra $13 for something that's at 100 over there?
Yes, dear, but your tax, income tax, that's direct tax. This tax is an indirect tax that comes off the selling price.
Okay, can you go please call the manager?
Fine. Okay, manager, can you come to aisle 4? Thanks.
Hi ma'am, how are you doing today? Can I help you?
Hi, I'm doing good. I was just confused that why is she charging me an extra $13 for the price that you've written over there as $100?
Okay, let me break it down. So if you don't want to be like our friend Hannah and be confused between direct and indirect tax, let us explain to you what is tax. So tax is a fee charged by the government on your income or a product. So direct tax is when a tax is imposed directly on your personal income or corporate income. That is direct tax, just like your sales tax or your property tax. On the other hand, indirect tax is when a tax is imposed on the selling price of a product, just like the sales tax. Okay, so the main difference between direct and indirect tax is that for direct tax, it is paid off by the person or the individual that it is imposed upon. Just like income tax is cut off from your salary. You cannot pass it on to another taxpayer. But for indirect tax, it's on the selling price, which can be shared by the buyer and the seller. So there are two types of indirect tax. One being the specific tax and the other being the percentage tax. So first I'm going to talk about the specific tax. So the specific tax is a specific fixed amount of tax imposed upon each unit of the product. So for example, on the graph, so if this is a supply curve, and we're talking about price per candy. So first, there were three candies produced and supplied for $3. And after the $1 per unit tax, the supply curve goes up. So I'm going to try drawing that now. S plus tax. So here it's $1. So throughout, for each unit of production, the price goes up by $1. No, don't do that. Because this tax increases the firm's cost of production. So that's why the price for each unit goes up by $1. Okay, so now percentage tax. As the name suggests, percentage tax is a percentage of the selling price that is paid upon the tax. So before the supply curve, as we saw minutes earlier, that it went up by a specific amount. But for percentage tax, it's going to go up by a certain percentage of the selling price. So for example, if the company was producing 5 candies for $5, now because of the 20% tax, the supply curve will have to move up. So this is going to be supply plus percentage tax, which is 20% in this case. So from for 5 quantities, the price will have to go up by $1 because the price was $5 and 20% of 5 is $1. So here the shift was of $1. However, as the price increases, the amount of tax also increases. So for example, if the price was $10, at $10 they were producing at X amount. Now, the price is going to go up by $2 because 20% of $10 is $2. So for here, the supply curve moves up by $2. So this shows that as the price increases, the supply curve plus tax, the gap between them becomes wider and wider.
So now, why would the government implement an indirect tax? Well, one reason would be so that the government would gain revenue. The second reason would be that so that the government would discourage the consumption of a certain good. For the following graph, we are going to talk about the good of cigarettes. So the government would want to discourage the use of cigarettes, but they would want to gain revenue at the same time. Okay, so to continue on from Georgia's specific indirect tax, we can see that the supply curve has shifted up to the left. So now we're going to look at the impact of the tax on the consumers, the government, and the producers. So as we can tell, price rises from P1 to P2.
No, don't do
So that means price rises for consumers, which isn't such a good thing for them. But for the government, they gain tax revenue from P2 to P3 all the way to Q2. So this rectangle you see here, that is the government, that is the revenue that the government earns. Now the impact on producers. The producers lose revenue as a result of the indirect tax. So the producer revenue falls from P1 to Q1, so that is what they earned originally. And now what they make is P3 to Q2. So from P1 to Q1 is what producers originally made, but now the revenue has decreased to P3 to Q2. Okay, so now we're going to look at who pays for the tax burden. So both producers and the consumers pay for the tax burden. And I'm going to illustrate to you right now who pays for what burden. So from P2 to P1, let me sheet it. So the consumer burden for the tax is illustrated from P1 to P2 times Q2. So the shaded area right here, that is the consumer burden of the tax. The producers pay for the rest. So the producer portion of the tax would be from P1 to P3 times Q2. So let me shade it in right. So the blue area represents the consumer burden and the green area represents the producer burden. And now you see right here the triangle.
Is Illuminati confirmed?
This triangle represents a deadweight loss, where it's a loss of producer and consumer surplus. So as we can see on the graph, there is a price P4. P4 is the optimal price that producers would want to have the consumers pay, because that would mean the consumers would pay the entire price of the tax burden. So if they were to do that, producers would set the price at P4, but there's a problem with that price. At P4, there is excess supply because it's not the market clearing price. So in order to clear the market and reach an equilibrium, the proper price that would have to be set is at P2. So P2 would be the market clearing price. And so that is why producers cannot set the price at P4 and must equally share the tax burden at P2. So overall, after the imposition of the indirect tax, the size of the market falls from Q1 units to Q2 units. This may have implications on the level of employment in the market, as firms may employ fewer people. So overall, as an effect of the indirect taxes, the prices go up, quantity is restricted, and the government gains tax revenue.
Now you have finished learning about taxes, but don't fear, the government doesn't just like to take away money, they also like to give us money in the form of subsidies. Now let me talk to you about subsidies. What are subsidies? A subsidy is an amount of money paid by the government to a firm per unit of output. Why are subsidies given? To lower the price of essential goods such as milk for consumers. This will increase consumption. Number 2, to guarantee the supply of products that the government thinks are necessary for the economy. Examples include food and power supply like coal. Number 3, an industry may create a lot of employment which would be lost and result in economic and social problems. Number 4, to allow producers to compete with overseas trade to protect domestic producers. Some things governments consider when granting a subsidy. Number 1, the opportunity cost of the government's money. Number 2, whether the subsidy will cause firms to become inefficient. And number 3, the effects on foreign producers who are not receiving subsidies from their government. A specific subsidy is a specific amount of money that is given for each unit of the product. The market is at equilibrium with Q being supplied and demanded at a price of P. The supply curve will shift to the right to create a new supply curve, S plus subsidy, by $2 since a subsidy of $2 per carton of milk is being granted. Okay, so governments pay this red section, which is P1, D, W, and Z. So this is the amount of this government subsidy that is given to producers that allow the quantity to be shifted to Q1. This allows producers to create a greater quantity of milk at a lower price of P1. So this means the quantity of milk will be cheaper. Okay, so a new equilibrium is created where Q1 is supplied at a lower price of P1. So the subsidy is passed on to the consumers at a lower price of P1. However, the price does not fall the whole amount of the subsidy, which would be at P2. So the red shaded area shows the increase in producer revenue. So the producer revenue increases due to the reduced cost of production, which allows producers to supply more at every price. So this green shaded area is the change in consumer expenditure after the price of P fell to the price of P1, and there was an increase of quantity from Q to Q1. So overall, consumers and producers benefit with subsidies as you get more for less.